by 2021, India's NSE was trading the largest amount of volume in F&O contracts across the world. They banned one of the world's largest hedge funds, Jane Street, from participating in the Indian market. SEBI has right now fined Jane Street for 4.8 thousand crores. On July 3rd of 2025, SEBI dropped a bomb on the Indian market. They banned one of the world's largest hedge funds, Jane Street, from participating in the Indian market and put a fine of more than $4,000 on this entity. This event sent shockwaves around the industry. People on large dealing desks, foreign hedge funds, foreign participants, everybody was speculating on what happened and how that would impact the growing Indian market. This also shone a lot of light on India's growing derivative market. India's F&O market, with these new structures that have come up in the last 4 or 5 years, like the weekly expiries, has become massive in size and it is prone to manipulation with these large entities. There's also a lot of data that has come up about retail traders losing a lot of money when they go to F&O investors. So this and much more, we'll try to understand this event, what happened and what's going to happen next in the Indian derivative segment and what retail traders need to do to protect themselves in this video. So let's start by talking about India's growing F&O market. India's market in the F&O segment has not just grown, but it has actually exploded in the past few years. In fact, by 2021, India's NSE was trading the largest amount of volume in F&O contracts across the world. And by 2024, almost 60% of the whole world's derivative volume was being traded in India. During these times also, the retail participation has grown a lot in the markets. You've seen in the wave that happened after COVID, the Indian retail investors is putting a lot more money into the markets and also speculating a lot in the derivative segment to make quick bucks from the market. To understand the significance of these numbers, look at the volumes of Bank Nifty. Between FY21 to FY24, the volumes of Bank Nifty have in fact grown 14 times. Similarly, Nifty contract has grown 3 times, but you can see the amount of volumes that are happening in the Bank Nifty contract. A key point here is that 96% of all this volume is coming from index derivatives, right? So only Nifty, Bank Nifty, future and options contribute 96% of all F&O volume. You would see that 52% of option buyers in the index are still retail investors. And if you look at the data coming from SEBI, you would see that a majority of those retail investors have lost their money while doing F&O trading. As per SEBI, only 9% of these F&O traders make a profit from F&O trading. And of those 9%, only the 1% make 51% of all profits. So you can see that this market is a way through which a lot of these F&O retail traders seem to be losing a lot of money to the larger hedge funds. Now that whenever any market evolves, you would see newer and newer structures, new derivatives come in to make the market much more efficient. But the weekly expiries, which was started only a few years ago, have really exploded in terms of volume. If you look at the volumes in the Bank Nifty weekly or Nifty weekly, you'll see a meteoric rise. So while these contracts have come with a good intention in the market, they are right now being used for a lot of speculation and a lot of gambling behavior in the market. And as it turns out, the retail investor is actually the losing party in this gamble. Now let's talk about what happened with Jane Street and what were the allegations that SEBI has put across. So in the report that SEBI put out, there are 21 specific instances where Jane Street has come and manipulated the index prices by itself. So to understand it, see, Jane Street is a massive global hedge fund. They do more than 10 billion in terms of revenues on a yearly basis, and of that they make 70% in terms of margin. They have immense amount of capital, and with that capital, they were sort of manipulating the stock prices to move in their favor. So for example, what they would do is, in the morning, they are buying a lot of stock, right, in the cash segment to inflate the prices up, right? So as the stock prices got inflated, you would see the option price for the put option of the Bank Nifty would go down quite a bit. So they would buy this option at a much lower price and then again manipulate the market to go down in terms of stock prices. So their option premiums would jump up and they will end up making a big profit by manipulating the whole market by itself. Now, if you have followed this case, you would have read that some people might say this is just an arbitrage, this is just somebody taking advantage of an opportunity. But in fact, this was not a small arbitrage. They were not just filling a short-term inefficiency. They were actually changing the integrity of the Indian market. So the stock prices, the movement of stock prices are not dependent on supply and demand, but it is being manipulated by this large party. SEBI has highlighted there have been a lot of artificial spikes that have been caused because of this manipulation. SEBI has concluded there was no economic purpose behind these spikes and manipulated movements that were happening in the market. These were just movements manipulated by this large party. And in terms of profits, SEBI has right now fined Jane Street for 4,800 or 4.8 thousand crores in terms of profit, which is roughly $500 million. But people speculate that the profits that Jane Street has made from India are of a much higher magnitude. And that is why very promptly, even after refuting these allegations, Jane Street has paid that fine and come back to the Indian market because they have been the biggest money makers from the India's derivative trade. If you look at the last couple of years, Jane Street has made billions and billions of dollars from the Indian market. Now, for the benefit of the retail investor, let's try to understand the craziness of weekly expiries. So weekly expiries with multiple exchanges and multiple contracts were structured in such a way that in the past few quarters, what you were seeing is that every other day was an expiry. It was Sensex or Nifty or Bank Nifty or Fin Nifty, something or the other had an expiry day in all the days of the week. And expiry day is when you see sharp movements in terms of time decay, you see sharp movements in option prices, and that's where a lot of active F&O or option traders and these active hedge fund strategies participate. And obviously the retail participation jumped 2-3 times as the number of expiries increased, as the number of these weekly contracts has increased. And your hedge fund parties, right, they tend to make the most amount of money when there's a lot of speculative activity in the market. They have set strategies through which either they can make these short-term profits, or if they are Jane Street, they can just move the whole market to make money. So that volume has also increased due to these weekly expiries. So there's several strategies that people typically follow during the expiry day. They would, short a straddle or a strangle, which means they're selling both a call and a put because they think that the expiry is going to be range bound and they will make the premium that, of the option that they have sold. Second is a lot of people do speculative directional buying and selling. So they think, okay, the market is going to go down, so I'm going to buy a put, or market is going to go up, I'm going to buy a call. This is less risk managed, and that activity is also very prevalent among retail traders. Sometimes, people who are more sophisticated will do more, sophisticated scalping or gamma and vega trading, which means that they think that in the last hour or half an hour of the expiry, the IV based premium is going to go down and they will bet against that and make some money. But this expiry day culture has led to a lot of surprises that have disrupted these strategies. One being that, while you're betting on a smooth expiry and prices to go down, some party will come and manipulate and cause a sudden surge that, makes you lose a lot of money on your short gamma strategy. Similarly, the stuff that we saw that, in the last half an hour, one party like Jane Street would pump up the prices in the first 10 minutes so that, your premiums go down, and then in the last minute, they will just push the prices down because of their scale, and they'll make a lot of money on the options that they have bought. And because of that, a lot of retail investors, who might have been influenced by a lot of influencers that you see on YouTube, on different social media platforms, who give you tips on options and all that, a lot of people actually come and speculate in the market because, an option strategy, if it works, has the potential to give you 10x profit or something like that, right? So a lot of people speculate in the market with these strategies, and that has in fact led to more than 90% of people losing their money in the market. And that is what has got the regulator also a little bit worried and thinking of ways that they can improve the situation. So obviously Indian market seems to have been rescued in this scenario by the SEBI, and SEBI right now is proposing a lot of proposals on how we can counter such manipulative behavior and how they can safeguard the retail investor from losing all their money in this speculative trade. There are various ways in which they want to, sort of correct the situation. One is intraday open interest monitoring. They will monitor the open interest in various contracts at various times during the day, which will help them flag if there is any speculative activity that is happening. They've also put position limits on these contracts, so any single entity cannot have more than 1500 crores in terms of exposure into a single contract. So position wise limits have been implemented to not let one party sort of move the whole market. There is a lot of other things that you hear. One is that they want to increase the lot sizes so that these contracts are not available to the retail investor, which is something that they've been thinking about. Another thing that we have heard is they want to reduce the weekly expiries. They don't want to have so many contracts, so many expiries where there's a chance of a lot of price manipulation. And we can see that the weekly contracts is where massive volumes lie, right? It's not in the monthly contracts. So they might want to reduce the number of weekly contracts as well. There's many other things that you hear where they want your short or your derivative exposure to be countered with your actual delta positions, right? Or something called FUTEQ, where they are combining future and option position to net what is the exposure that you seem to be taking. And along with it, there are a lot of behavior nudges. See the report that come out in this action that SEBI has taken, through which they try to educate the retail investor about the speculative nature of these markets and about the amount of losses that are being built by the retail investors in these markets. So if you look at the current scenario from the big picture perspective, you would see that India is at the crossroads of F&O trading. Indian markets are definitely evolving with new IPOs coming, the size of the cash market growing at a great pace, but the derivative exposure seems to have outpaced the growth of the cash market. And a lot of things have come out in this growth, right? In this disproportionate growth. One is that the retail investor somehow is overexposed to derivative strategies. There seems to be a lot of speculation that retail investors seem to be doing with future and options, and they are losing a lot of money. Second thing you would see is there's a dominance of algorithms, so large hedge funds, Indian prop trading funds, and anybody who wants to make money from the market. If somebody is speculating or gambling, they tend to be very inefficient, and they are easier to make money out of a game, and that's where you're seeing a lot of algos also come in. And finally, it has highlighted the fragility of this growing market. Things are not efficient, things are not sound. It's highly disproportionate towards the algorithmic trading guy, and it is highly disproportionate towards the person who has the larger amount of capital, because they can come and manipulate the market until unless the regulator steps in. SEBI also has a few things to think about. One is obviously they want to protect the retail investors, but they also want to keep the liquidity coming in from the foreign players to the Indian market. Secondly, they want to give people options to hedge with these future and options, but they don't want to encourage gambling in the markets. And finally, they want to bring in more innovations. For example, the derivative market in India is still very less evolved in comparison to the global market, but they also want to make sure that these markets are not being abused. So Jane Street's story in the market has really shaken up the whole market. The strategies that were working have changed. The whole microstructure of the market has changed. You would have seen the volumes of NSE and BSE reduced quite a bit. You saw a big impact in the BSE stock prices and NSE price in the unlisted market, because these volumes that were happening with Jane Street would come down. You've seen some brokers and custodians like Nuvama, Angel One be impacted because volumes have reduced. And people are speculating on the growth prospect and the global liquidity that was freely coming from these FIIs impacting the Indian markets. It's a big event, but in the long term, if more efficiency is brought into the market by making sure that actually supply and demand and economic reasons move the market, that will make our Indian markets much more efficient and move in the right direction. So while we are seeing some short-term adjustment in certain stocks, in the long term, such corrections in the market would make it more and more efficient. So that was our analysis on whatever happened with Jane Street and how it's going to impact the Indian derivative market. If you like this video, please do hit the like button, comment and let us know what you thought, and subscribe to our channel. You can share it across with your friends also who might want to understand the scenario in detail. We'll see you again in the next video. Until then, happy investing.
Investment in securities market are subject to market risks. Read all the related documents carefully before investing.